Did you know that one seemingly innocuous financial decision could be the very thing that triggers a deep, intrusive review of your entire benefit status? For veterans, the financial landscape is fundamentally different. It's not just about paying taxes and saving for retirement. It's about navigating a labyrinth of interconnected federal benefits, disability ratings, and means-tested programs where every dollar earned, every asset moved, and every location you call home is scrutinized through a very specific and often unforgiving lens. We're talking about the silent triggers, the moves that look perfectly safe on the surface, the things that any smart civilian would do, but which quietly raise a massive red flag in the VA or DoD computer systems, demanding a closer, sometimes painful look at your life. These are the decisions that can lead to benefit reduction, demands for repayment, or even formal investigation. Today, we are breaking down 3 of the most common, seemingly harmless financial moves that veterans make every single day, which are actually putting their benefits at serious risk. If you are a veteran receiving disability compensation, a pension, or utilizing specific educational or healthcare benefits, you need to hear this, because the system is designed to catch inconsistencies, and consistency is your greatest financial defense. Let's dive straight into the first major tripwire, and this one catches more people than almost any other category: the innocent side hustle that accidentally invalidates your disability claim. You hear it all the time. "I'm retired, but I need something to keep busy," or "I found a way to make a little extra cash doing something I love." This is the side hustle paradox. A civilian sees a side gig as extra income. The VA often sees it as evidence that your claimed limitations may be overstated, or worse, inconsistent with your current earning capacity and physical activity level. The core issue here is the dissonance between the documented medical limitations used to secure your disability rating and the actual actions you perform to generate income. Think about it. If you have a 70% rating based largely on severe limitations related to mobility, chronic pain, or mental health struggles that make maintaining regular employment impossible, and then you start a business that requires you to actively manage inventory, physically deliver goods, or maintain a demanding, high-stress schedule, the system will notice. The flagging doesn't happen because you deposited $500 from a yard sale. It happens when you establish a pattern of income that necessitates a specific level of physical or mental engagement that directly contradicts the narrative of your service-connected condition. For example, let's look at the veteran who has a significant orthopedic disability rating, claiming difficulty sitting, standing, or lifting. That veteran then decides to start a successful woodworking business, posting videos online showing them lifting heavy lumber, operating complex machinery for hours, and standing at a workbench all day. Now, they are properly reporting this income to the IRS, which is the smart and legal move, but that IRS data is cross-referenced. The moment the system sees sustained reported self-employment income generated from an activity that clearly requires high levels of physical stamina or complex motor skills, an automatic trigger is pulled. The result? A letter arrives demanding a new compensation and pension exam, specifically focused on your ability to perform the tasks required by your new occupation. This isn't about the VA trying to punish entrepreneurship. It's about verifying that the compensation you receive accurately reflects your current level of impairment. If your income-generating activity demonstrates a capacity far exceeding what was previously documented, your rating is vulnerable. The same insidious trap applies to mental health ratings. A veteran with a high rating for service-connected post-traumatic stress disorder, PTSD, or major depressive disorder, whose claim documentation emphasizes severe social isolation, inability to handle public pressure, or difficulty managing others, might decide to start a highly successful online coaching business or run a popular, high-engagement social media channel. While this income is a blessing, the nature of the work, the requirement to be highly communicative, publicly visible, and managing complex interactions can be interpreted as evidence of significant improvement in the very symptoms that warrant it. The high rating. The sheer volume of public-facing engagement required to run a successful channel or coaching practice can directly contradict claims of social avoidance or debilitating anxiety. The key takeaway here is not to avoid working, but to ensure that if you do engage in a side hustle, the demands of that work are consistent with the limitations outlined in your disability file. If your work requires you to push past those limitations, you must be prepared to demonstrate how you manage the condition while performing the work, and be ready for a review of your rating. The financial move here, starting a business and reporting the income, is absolutely safe and required by the IRS. But the context of that move within the VA system is what turns it into a red flag. Always consult with a benefits specialist to understand how changes in your occupational function might impact your current rating status before launching that new venture. Moving on to the second major financial move that often triggers deep scrutiny, we enter the territory of complex family finances, the seemingly innocent co-signed loan, or the large, undocumented gift. This area is particularly dangerous because it, often impacts veterans who rely on means-tested benefits, such as the VA non-service-connected pension, often referred to as aid and attendance. These benefits are strictly contingent upon having limited assets and income. When the government calculates your net worth for these programs, they are looking for a clear, verifiable picture of your financial independence. Any move that muddies those waters or suggests you are hiding assets or liabilities can immediately trigger an asset divestment audit or a means testing review. Let's start with the co-signed loan. Say your adult child needs help buying their first house or a new car, and they ask you, the veteran, to co-sign the loan. This feels like a responsible, supportive parental move. However, when you co-sign a loan, you are not just lending your credit score, you are formally assuming a contingent liability. To the VA, this can look like one of two things, both of which are problematic. First, it can artificially inflate your apparent net worth, especially if the asset being purchased is large. Second, and more critically for means-tested benefits, if the primary borrower defaults, the debt immediately becomes your debt. While the VA generally doesn't count contingent liabilities against you initially, the movement of large sums of money associated with the closing of the loan, the subsequent monthly payments that might flow through your accounts, or the sudden assumption of a massive debt load can trigger an automated audit looking for asset manipulation. The system is designed to detect sudden large fluctuations in your financial profile. A co-signed mortgage for $300,000, even if the primary borrower is paying it, creates a substantial shadow on your balance sheet that the VA will want clarity on, particularly if you are simultaneously claiming poverty to qualify for a pension. The paperwork required to prove that you are not financially responsible for the payments can be extensive, intrusive, and delay benefit processing for months. Now consider the gift trap. This is extremely common, particularly when elderly veterans are trying to structure their assets to qualify for aid and attendance benefits, or simply trying to help their grandchildren with college tuition or a down payment. Giving a large sum of money to a family member seems like a generous and smart way to reduce your taxable estate. However, the VA has strict rules regarding asset transfer, specifically designed to prevent veterans from artificially reducing their net worth just before applying for means-tested benefits. This is known as the look-back period. If you transfer assets for less than fair market value, i.e., you give a large, non-reimbursable gift, within the look-back period, currently 36 months for the VA pension system, though rules are subject to change, and state-specific regulations may vary, that gift can be counted against you as if you still owned the money. The VA will impose a penalty period during which you are ineligible for benefits, calculated based on the amount gifted. The danger is that veterans often don't realize that the intent of the gift doesn't matter. The timing and the amount are what trigger the flag. If you gift $50,000 to your grandchild for college, and then, 2 years later, your health declines and you apply for aid and attendance, that $50,000 transfer is scrutinized. Even if you receive the money from an inheritance or a legitimate source, the transfer itself looks like asset divestment. The flag is raised because the system sees a substantial reduction in assets that is inconsistent with normal living expenses. To avoid this, every single large asset transfer, whether it's a gift, a sale of property, or a transfer to a trust, must be meticulously documented and, ideally, handled well outside the look-back window. For any veteran approaching the need for means-tested benefits, the co-signing of loans or the transfer of large assets without professional guidance is essentially waving a financial flare gun, guaranteeing a detailed and potentially punitive review of their eligibility. This area demands absolute transparency and proactive planning, because retroactive explanations rarely satisfy the VA's requirements for financial consistency. Finally, we arrive at the third major financial move that quietly gets veterans flagged: the strategic geographic shift, often referred to as the residency shuffle. This move is usually undertaken with the best of intentions to save money on state income taxes, access better educational opportunities for children, or leverage state-specific veteran benefits. However, when a veteran attempts to claim residency in one state for tax benefits while simultaneously utilizing federal benefits tied to a different previous domicile, the conflict in data sets can be a massive trigger for auditing by the VA, the DOD, or the IRS. The core problem here is the legal definition of domicile versus residence. Domicile is your true, fixed, permanent home where you intend to return, while residence is simply where you live temporarily. Federal benefit systems, especially those related to health care, like specific VA facilities or TRICARE rules, and educational benefits, like post-9/11 GI Bill usage and state matching programs, are often highly sensitive to where your permanent domicile is established. The common scenario looks like this. A veteran lives in a high-tax state like California or New York, but decides to legally change their domicile to a no-income tax state like Texas or Florida. They get a new driver's license, register to vote there, and maybe even buy a small property or rent a P.O. box. This is the safe financial move because it saves thousands in state income tax. But then they continue to spend the vast majority of their time, say 10 months of the year, back in the high-tax state, utilizing the local VA medical facilities, enrolling their children in local state schools under resident tuition rates, or claiming a homestead exemption on their property in the original high-tax state. When these conflicting data points hit the federal databases, a red flag is immediately raised. The IRS sees you claiming residency in State A for tax purposes. The VA sees you consistently utilizing primary care services in State B. The state university system sees you claiming resident tuition in State B. These discrepancies suggest that the veteran is playing a shell game with their domicile to maximize benefits and minimize taxes, a practice that leads directly to residency audits. What specifically flags the system? It's the inconsistency across official records. If you claim Florida residency but your vehicle registration, voter registration, primary banking address, and utility bills are all still tied to a property in Oregon, you have not established true domicile. The moment an audit is triggered, the veteran is required to prove their intent to make the new location their permanent home. This means showing proof of physically severing ties with the old state, selling the previous home or changing its classification, transferring professional licenses, moving primary medical records, and establishing community ties, church, clubs, etc. in the new state. If the veteran is found to have falsely claimed domicile to avoid taxes or secure state-specific benefits, like in-state tuition, they can face back taxes, penalties, and, crucially, a review of their federal benefits based on potential misrepresentation. Furthermore, This residency issue often intersects dangerously with VA disability claims. Imagine a veteran whose disability claim relies heavily on access to specialized medical care available only at a specific VA facility in State C. If that veteran suddenly claims domicile in State D for tax purposes, the system may question the necessity of their frequent, sustained travel back to State C for appointments, potentially leading to questions about the true severity or constancy of their medical needs or their capacity for travel. The financial move, saving on taxes, is smart, but the failure to execute a complete and verifiable change of domicile across all federal and state records transforms that smart move into a liability. Consistency is paramount. If you move, ensure your driver's license, voter registration, vehicle tags, bank accounts, and primary health care provider all reflect the new, true domicile. Anything less is an invitation for the system to question your integrity and trigger a comprehensive review of your entire benefit package. In summary, the three seemingly safe financial moves, the side hustle that contradicts your claimed disability, the co-signed loan or large gift that complicates means testing, and the strategic residency shuffle, all share one critical common thread. They introduce profound inconsistency into your financial and personal profile. The VA and DoD systems are not static. They are constantly cross-referencing IRS data, Social Security data, state records, and even public information. When a veteran's reported income activity contradicts their documented physical capacity, when their declared poverty for a pension is undermined by complex asset transfers or liabilities, or when their claimed residency conflicts across official documents, the system's automated flags are triggered. Protecting your benefits is less about avoiding financial activity and more about maintaining an ironclad consistency between your claims, your actions, and your documentation. If you are starting a business, ensure the physical demands align with your medical profile. If you are helping family financially, ensure you understand the specific look-back periods and asset transfer rules for any means-tested benefits you currently receive or anticipate needing. And if you are moving, commit fully to establishing true domicile in the new state, ensuring every piece of identification and every official record reflects that single, fixed location. Remember, the safest financial move you can make as a veteran is transparency and proactive planning. Never make a major financial decision that touches income, assets, or residency without consulting a VA-accredited financial advisor or benefit specialist. Your financial security depends not just on what you earn, but on how consistently you present your life to the federal agencies responsible for your care. Stay consistent, stay documented, and stay protected.